everybody, and welcome to 7 Investment Management Q4 Asset Allocation Committee's results and presentation. It's Chris Darbyshire and Tom Sheridan from 7IM. Now, we are going to go to a little deeper dive into what's going on in China. Now, Chris, let's talk about, we've got some slides for you which will appear on your screen. So let's talk about services versus manufacturing in China.
So China has been through its period of easy, rapid growth, where you turn inefficient agricultural labourers into efficient city workers. And this period of growth, which has lasted almost 20 years, generated great rapid growth, is coming to an end. But the way that growth happened is through really building industrial power plants, factories. China became the manufacturer to the world. And the government is now looking to reposition the economy away from that, because actually what's happening in China is wages are going up very fast, which is very good news for Chinese people. It's very good news, I think, for the stability of China, but it's bad if you're trying to be a competitive exporter.
So in this chart, China in transition, we're seeing that somewhere around 2012, 2013, services became a bigger percentage of GDP than manufacturing, and the direction of travel is actually quite steep.
Yes, absolutely. So when you look at Chinese GDP growth today, really there are two separate economies going on. The services economy growing at 10% a year, and the manufacturing or the industrial part of the economy growing at a much slower pace, perhaps not even growing much at all.
The next one is a very busy slide. And it focuses on consumer growth, and there was a couple of little bubbles that you put on the right-hand side of the slide. It highlights to me that we've got 10.5% growth in consumer spending. It also highlights to me that we got 36%, which is online.
Yes, so online sales in China are growing incredibly rapidly. And indeed, as you say, retail sales at double-digit rates of growth. This is the transition happening. So this is what we want to see. We want to see the economy slowing overall, but with the growth being led now more by services and less by industrial activity.
And down lower on that page, you see minus 6.9%. That represents the oil contribution.
Correct, and of course the oil price has dropped a lot. So what there's two factors in there. There's the much reduced oil price and then the much greater volumes.
So this means the consumer is spending less on oil. So effectively, they've got the same thing as a tax cut.
Exactly, and this is really what is a really important part of our thinking, is that the lower oil price, it does put money in people's pockets. And what the world has been lacking over the last few years has really been demand. So this tax cut could be pretty useful.
Very useful. Growth has been what the world has been seeking, and perhaps the impact of the lower commodity prices will help that consumer spending. What's going on with property? We talked a little bit about it a couple of moments ago.
Yes, so 2013, 2014 was really the great property bust in China. And I think there was a lot of concern among investors that this would lead to social unrest, to massive bankruptcies around the country. And it's not happened. The government has done a very good job of managing the slowdown, of helping people with improved mortgage terms, keeping interest rates low. And the results of this are coming through now. We've seen 5 or 6 months of consecutive growth in property transactions.
And the next one, probably the other side of the same coin, loan growth in China. Also, similar picture. We've seen an uptick in 2015.
Yes, I think it's a compromise in China between, do you want to grow the economy, but also do you really want to stimulate more debt funding? I think debt funding in China, it's there because there isn't really a lot of equity funding. Until recently, there really wasn't a culture of equity investment in China. So you do see a lot of debt. But I think short-term rebound in debt is probably not a bad thing.
And how are the companies doing?
So earnings in China are fine. I think this is really one of the really important fundamentals around the world, that we're not seeing a great deal of weakness in earnings. Where we are seeing weakness in earnings, a lot of it is currency translation effects, so it's the strong dollar again, making earnings look weaker than they really are. In China, both revenues and earnings are pretty good. Revenues are very good in the services sector and less good in the industrial sector. But in the old industrial sector, even earnings are growing at 10% per annum.
Okay, so this is looking not like the disaster scenario that we're reading in the headlines if we take a look at what's going on in the underlying economy, and indeed that has been the 7IM position. We've been hurt by taking that position, but we're staying with it. Let's look at the currency slide.
So this slide is showing the value of the Chinese currency, the renminbi, on a trade-weighted basis. So this is looking at who China actually trades with. So 50% of the trade is with the US dollar, 50% of the change in value is linked to the dollar. And you'll see that over the past few years, there's been about a 31% rise in the value of the Chinese currency. And after that 31% rise, we've had a tiny correction. It's a blip at the end of the chart of a mere 2.6%, which is again why we think that it was the fear of further devaluation that set markets off. The actual impact is really very tiny.
Okay. So look, I think you've made the case that China is not falling apart. There is slower growth, but we don't think it's catastrophically slower. Let's move to the world in general. Global manufacturing, we said it before, it's subdued.
Yes, it's been on a downward trajectory for a few years. And a lot of academics are scratching their heads at the moment, wondering why are services so strong around the world and manufacturing so weak? And the best accounts that I'm seeing are that the GDP data really is beginning to not track growth very well. It doesn't track, for example, the increased productivity of a mobile phone. The fact that your mobile phone can now sense whether you're healthy if you have all the latest gadgets on it, and that's great productivity, but you just can't capture that in economic data very easily.
Right. So again, the headlines are the manufacturing data, but certainly that's not the whole story anymore. And that's from the global perspective. In the U.S., what's going on there? Now, this chart, you've got two different lines on the chart here. Maybe you can explain what the two different lines are.
Yes, so you've got, on this chart, you've got a lighter grey line, which is the US dollar trade weighted again, so in accordance with its trading parties. And then the blue line on this chart is a survey of whether manufacturing companies are seeing sales pick up or decline.
And one's going down and what's going up? Explain that to me.
And this is what you would expect. So when the dollar goes up, which is when the dollar's appreciating, US manufacturers become less competitive. They become less competitive, in the foreign markets for their products, but don't forget they become less competitive at home because they're also competing with foreign manufacturers at home as well as all around the world.
So there's the picture that you referred to earlier where the strong dollar is having an impact.
And that is exactly what we would expect to see.
That into context of the overall U.S. economy and manufacturing and services combining to form GDP. What does that picture look like?
So manufacturing, it's a shrinking part of the U.S. economy. It's now down to about 13%, whereas services are nearly 2/3 of the U.S. economy. So I think what we have to weigh up is the concern that weakness in manufacturing and manufacturing employment could spread to the broader economy. It could end up impacting the services part of the economy. On the other hand, the much bigger strength we're seeing in services could also help to rectify the problems in manufacturing.
So just by contrast, we said 13% manufacturing for GDP in the US. China is?
More like 45%.
Right, so China manufacturing as a percentage of the overall GDP has a long way to shrink to get to developed nation status.
Indeed.
Okay. So Europe, what's going on in Europe?
So Europe, we have this same issue where the services are doing a bit better than manufacturing. European manufacturing is, I'd say okay, better than US manufacturing. but it's still relatively weak, whereas it's a services part of the economy again that's growing quite well. And particularly in Germany, consumption's doing very well indeed.
So we're overweight in Europe, and that's a lukewarm endorsement of what's going on in Europe. Is it the valuations that you like?
Very much we like the valuations in Europe. We like the fact that the weak euro is helping profitability of European companies. It's helping their export competitiveness. And there are a lot of exporters in the European stock market.
So a modest rebound from an economic standpoint, currency looking like it's going the right way for the company earnings, as well as the pullback leaving us with attractive valuations.
Exactly, yes.
UK?
UK, again, a very, very strong economy, particularly strong in services again and consumption, less strong in manufacturing. The pound has been very strong like the dollar has been very strong. So we don't have a lot of investment in the UK. We've recently increased our exposure to UK large companies, as I mentioned, because we think they're more exposed to commodities prices, and we think there could be a bit of a rebound in those prices once China begins to invest again.
Okay. So we talked before, moving on from the UK now to global trade. We talked before about the impact of the dollar having on the global trade numbers and the fear that that created in markets. We look at this particular slide, Chris, and, well, the headline says it.
It's not that bad. I mean, there is a slight dip at the end of the chart, but it's nothing, to write home about. And this is, again, you need to be really careful. If you're looking at global trade in dollars, year to date, it's down 17, 18%, which is a huge, huge decline. Looking at it there in volumes, barely a ripple.
Now, we've got one here called QE versus earnings. And you've got three different pictures. It's rather busy. What's the point that you're trying to drive out there?
So I think there's a school of thought out there that QE has somehow directly fed into stock market prices, and that the valuations are held up by hot air, really, by nothing more substantial. And what we're trying to show with these charts is simply that actually earnings have grown globally over this period. It's been mixed. US earnings have grown very well. European earnings have not done so well. But on the whole, valuations are reasonably supported by earnings, and particularly with the pullback we've had, I don't think anyone can be complaining about valuations anymore.
So the three different pictures are global share prices, emerging market, and Europe, ex-UK. And they're telling a similar story, are they?
Yes, and the one I particularly like to point out is emerging markets, where the profits are really incredibly solid. You think of all the press on how volatile emerging markets are politically, economically, but emerging market companies are masters of just making those profits year after year with a bit of growth thrown in.
Okay, so that's a lot of information for you to take in. However, there are a number of people who wanted that level of detail, and that's why we put it out. And indeed, we're happy to put more out if that's warranted. If we could summarize now, corrections happen probably 2 out of 3 years?
I think corrections happen. I think they will happen more and more in the modern world, where you've got traders linked up all over the world, markets all moving together. One small thing in one part of the world can influence markets across the world, where the trading, I think, is much more technologically advanced. It's more computerized and algorithmic trading than it is people trading on the economics or the fundamentals.
So our view is ride through the short-term noise, look at what the fundamentals are telling you, which in our view is not Armageddon. Stay with your positioning, expect volatility along the way, and particularly every time we get near a Fed meeting, you're probably going to get there. It's not really a Chinese slowdown. It's not really a US slowdown. We think that what we've seen is a market environment change over the last couple of months, and hopefully 3 to 6 months from now, we're sitting here saying to you, aren't we glad that we stayed the course? Thank you very much. For Chris Darbyshire and myself, Tom Sheridan, and we'll see you next quarter.